Hello and welcome back to a very wet and dreary London. There's still only really one topic to talk about in the markets, and that's oil. I've been catching up with an old favourite of London Direct, Jeremy Stretch from CIBC. It's good to speak to you, Jeremy. Last week I spoke to an oil analyst, asked him where the bottom of the oil price is. He didn't have a clue, in all honesty. So I might as well ask an FX expert, what's your take on the sell-off in oil and when are we going to see the bottom?
Well, clearly they're both demand and supply dynamics which have been driving the price substantially lower. It is very difficult to really call the bottom, but I think the ultimate reality is, of course, that until we see some degree of resolution to this demand-supply imbalance, it's very difficult to call a significant rebound in the short term. And of course, that's going to continue to have negative contributions for those oil-producing countries.
I was going to look at the FX implications, starting with the Canadian dollar. Is it a case that the movements of the Canadian dollar are solely going to be pegged to how the oil price is moving?
Well, certainly the correlation between the two has become elevated over the course of recent months. And if we are going to see the oil price remaining subdued for a prolonged period, then we're going to see a greater drawdown or reduction in the growth forecasts for 2015 and maybe even 2016. And as a consequence, we'll see the Bank of Canada pushed further into the middle distance in terms of any monetary tightening. So clearly, as a consequence of that, then the Canadian dollar is going to remain very much on the defensive. So it does underline our view that the Canadian dollar is going to underperform through 2015, and we can easily see a move up towards 125.
Are there not buying opportunities, though, with the Canadian dollar and also the Norwegian krona, as they do have relatively robust domestic economies? So once we see this oil price bottoming out and maybe starting to rise again, aren't there going to be buying opportunities there?
Well, that's possibly true, but of course it is a trade that would be fraught with danger because, as we just suggested, it's very difficult to call the bottom of the oil price purely based on the fundamentals, because there are both demand and supply dynamics at play. And of course, you're talking about geopolitical elements, whether you're talking about OPEC or non-OPEC members and their underlying contributions to the broader oil price. So yes, there may be opportunities, but it would be a very dangerous trade to really pursue at this particular juncture.
I just want to move on to another angle to this oil price sell-off, and that's the impact on inflation. We saw British inflation drop to new lows today. At what point, I'm trying to figure out basically, is this good for the UK economy or bad? Because the politicians are saying this is like a tax cut for households. Mark Carney is saying that this could mean that they have to keep rates lower for longer. What's your take on it?
Well, yes, that's right. I think there is a benefit to the consumer, as of course we all find that every time we go to the petrol pump, it's costing us less money. So in a sense, it is in effect a tax cut. But of course the question is it over time going to be concerned about inflationary expectations? Are they going to fall sufficiently far to really impact consumer sentiment and consumer spending? And I think we're not at that particular juncture yet. I think we're still talking about falling prices, which are good falling prices, if that can be characterised that way. That's because it's a one-off shock, which will put money back into people's pockets, is not due to a lack of overall demand per se in terms of the UK economy.
So what does this all mean for the pound? Because, as I said, Mark Carney's told the BBC today that this could mean that they have to keep rates lower for than they expected. So is this going to play out negatively? Well,
sterling's been under considerable pressure since peaking last summer anyway, and I think there are good reasons to suggest that we may well see further negativity as we go through the first half of the year, as we run into the election, as we see further political uncertainty in the wake of similar reactions to the Scottish referendum. So I think inflation falling, rates on hold for longer, political risk, I think all added together do suggest that sterling is going to underperform, certainly in the first half of this year, and we could easily see a test below 145.
Well, thank you to Jeremy for his analysis on the way things stand at the moment. Stay tuned to Dugoscopy TV for more interviews, but from London, goodbye.